So we are continuing with the dividend policy. You are continuing the dividend policy. So the last time the question we did was M and M, where you are confirming that payment or non-payment of dividends will not affect the value of the farm. Remember, we calculated the value for the farm when there was payment of dividend, and also the value of the farm when there was no payment of the dividend, and that value was coming to the same. So before we conclude now on that dividend policy, let us have something brief about other models of the dividend policy. We can write something brief about other models of the dividend policy. We can write something brief about other models of the dividend policy. Other models of the dividend policy. So number one should be James Walter model. So number one should be James Walter model. Number one should be James Walter model as another model of the dividend policy. So first, I will give you some small notes on that in relation to that model. Then I check a question on it. So we can write that it is a model of share valuation. It is a model of share valuation. It is a model of share valuation, which supports the view that dividend policy of the company, dividend policy of the company will affect the value of the share. Dividend policy of the company will affect the value of the share. It will affect the value of the share. It operates under the following assumptions. Number one would be that the company is all equity financed. Assumption number one is that the company is all equity financed. Then number two is that the company will only use retained earnings. It will only use the retained earnings to finance its future investment. It will only use the retained earnings to finance its future investment. Then number three is that the rate of return on the investment remains constant. The rate of return on the investment remains constant. Then number four is that the company will be existing until infinity. So I want you to check a question for November 2020, question 5, part B. I want you to check November 2020, question number 5, part B. Check November 2020, question number 5, part B. So I want you to refer to November 2020, question number 5, part B. So if you check November 2020. Question number 5, part B. November 2020. Question 5, part B, Roman letter 1. Question number 5, part B, Roman letter 1. So that question reads that Roman letter 1, Walter's model on the dividend policy believes in the relevance concept. It believes in the relevance concept of a dividend. According to this concept, dividend decision of the company affects its valuation. Dividend policy decisions affects its valuation required. Roman letter 1, discuss 4 assumptions of Walter's model. Umepata November, should be in the sitting of November 2020. Question number 5, part B. If you can see November 2019. Yeah, if you see November 2019 up there, it is that question number 5, part B. When you have November 2019 up there, there is a question number 5, part B. So that question 5, part B, Roman letter 1, they are asking that Walter model on dividend policy believes in the relevance concept of the dividend. According to this concept, dividend decision of the company affects its valuation. It affects its valuation. So they wanted you to discuss 4 assumptions of the Walter's model. So the assumptions are the ones that I've just given you. I've given you 4 of them. The first one, we have said that the company is all equity financed. The second one, we have noted that the company will only use retained earnings to finance its future investment. Then number 3 is that rate of return on investment remains constant. Rate of return on the investment remains constant. Then number 4, the company will be existing until infinity, i.e., it is a going concern. So those are now the assumptions. Those are now the assumptions of the James Walter on evaluation. Then now I want you to add there a paragraph. I want you now to add there a paragraph by summarizing that based on these assumptions, comma, Walter came up with a model. Based on these assumptions, comma, Walter came up with a model of valuing the shares as follows. Based on this assumption, comma, Walter came up with a model of valuation of the shares as follows. Of valuation of the shares as follows. So according to the James Walter, the value of the share, so PO is the value of the share. It will be equal to D, then plus in brackets A minus D. I will explain what each one of them stands for. Then R over K. We also divide by K like that. So we simply simplify it in that order. So according to Walter model, so to get the value of the share, it is D plus in brackets E minus D, then R over K divided by K, where D is the dividend per share, where D is simply the dividend per share. D is meant to be the dividend per share. Then E is the earnings per share. E is the earnings per share. E is the earnings per share. Then R is the rate of return on the investment. R is the rate of return on the investment. R is the rate of return on investment. Then K will be cost of capital. K will be the cost of capital. K will be the cost of capital. So I want us to get a question for May 2017, question number 2, part A. May 2017, question number 2, part A. So we can go to May 2017, question number 2, part A. May 2017, question number 2, part A. May 2017, question number 2, part A. So when you check that question for May 2017, question number 2, part A. Check May 2017, question 2, part A. So they have said that the following information was extracted from the financial statement of Mwaka Limited. Was extracted from the financial statement of Mwaka Limited. So earning per share has been given as 15. Capitalization rate is the cost of equity. They have given you 12%. Then retention ratio is given as 14%. Then internal rate of return is given as 16%. It is given as 16%. So required the price per share under the Gordon's growth model. Roman letter 2, Walter's model. So Gordon, we already know it, how to get the value of the share when we apply the Gordon model. So we can start with the Roman letter 1 when we use the Gordon model. When we are applying the Gordon model, when you are using the Gordon model, so Roman letter 1 is the Gordon's model. So when you apply the Gordon model, remember PO. PO was the price of the share. So PO is supposed to be given by PO in the brackets of 1 plus G. Then we divide by KE minus G. So when you want to calculate, according to Gordon, the one of the constant dividend growth rate. So this was the same as D1 divided by KE minus G. So there are a few things you need to calculate. You start by calculating G, it was not given. So to calculate G, which is not given, we use retention ratio method. We apply the retention ratio method, which is R multiplied by the return on equity, which is R multiplied by the return on equity. So retention ratio, we can get that. They gave us 40%. Retention ratio, they gave you 14%. So it will be 40%. So return on equity is now the same as our capitalization rate. Return on equity will be the same as our capitalization rate, whereby they gave us 12%. They gave you 12%. So multiply by 12%, so that we come up with our G. So we get now the constant growth rate. So what should be our constant growth rate? 4.8. Yeah, so we get 4.8%. The other thing you need to compute will be dividend per share. So normally to get the dividend per share, you simply take earnings per share multiplied by dividend payout ratio. Multiplied by dividend payout ratio. So to calculate the dividend per share, we simply come up with earnings per share multiplied by the dividend payout ratio. The question had given you earnings per share as 15. They gave you the earnings per share as 15. So retention ratio is 40%. It means payout ratio should be what percent? 60%. So get 60% of that shillings 15. Get 60% of the 15. Exactly 9. So after that, we go back to get our VO. So VO is now 9. the growth rate is 4.8%, which is the same as 0.048. We divide by KE. KE is still the capitalization rate. KE will still use the capitalization rate, which was what percent? So 12% is the same as 0.12. Then you also minus 0.048. So that should give you the value of the share when you are applying that Gordon's valuation model. When you apply the Gordon's valuation model, that now should be able to give you the value of the share. So I've seen 131. Yeah, so that is now when we use the Gordon's model. Let us now check Roman letter 2. When we use Walter's model, we now check when we apply James Walter model. When we use Walter model, we now come up with when we use Walter model. So when we apply Walter model, what should be the values? So when we use Walter model, so Roman letter 2 is Walter model. So when we use James Walter model to get the value of the share, it is D4. It will be equal to D plus in brackets E minus D. Then R over K. We divide again by K. Also divide again by K. So D we have just calculated. But a dividend of how much? So dividend is 9. E we already know it. Earning per share is which here? 15. You also subtract 9. So R, we already have it. R, we already have it. Rate of return. R is now our internal rate, which is what percent? 16. So 16% is the same as 0.16. K is the capitalization rate or cost of equity, which is 12%. That is 0.1. We also divide again by K, which is 0.12. Which is 0.12, which should be 0.12. So I've seen 141.67. Yes. Yeah, so that's now the James Walter model. So I was simply summarizing something brief on the dividend policy, whereby we are discussing other models of the dividend policy. So the first one was James Walter model. So now we go to number 2. We go to number 2. We also have the model number 2. So number 1 was James Walter model. Now check the model number 2 as. So number 2 will be Vintner's model. So So number 2, you have it as Lintner's model, Lintner, then Astroliters. So that is another model of the dividend policy. That is another model of the dividend policy. So we can write something brief on that model, whereby we summarize that it is a dividend policy model. It is a dividend policy model. It is a dividend policy model where dividends to be paid, where the dividends to be paid will take into account the dividends to be paid will take into account the current dividends, will take into account the current dividends, comma, adjustment rate or factor, the adjustment rate or factor, and the previous period dividends, Therefore, according to this model, comma, dividend per share to be paid. Therefore, according to this model, comma, dividend per share to be paid is expressed as follows. Dividend per share to be paid is expressed as follows. Dividend per share to be paid is expressed as follows. So when you are using the Lintner's model, dividend per share to be paid, will be equal to current dividend per share. You simply take current dividend per share, multiplied by adjustment rate, then we cross the brackets, then we add in brackets the previous period dividend per share, then we multiply that figure by 1 minus the adjustment rate, like that. So when you want to calculate the dividend per share to be paid, simply get the current dividend per share multiplied by the adjustment rate. Then we add in brackets previous period dividend per share multiplied by 1 minus the adjustment rate, multiplied by 1 minus the adjustment rate. So there is a question I want us to apply. May 2016, question number 2, part B. We got to May 2016, question number 2, part B. Check May 2016, question number 2, part B. May 2016, question number 2, part B. 2016, question number 2, part B. So that question for May 2016, question 2, part B. That question 2, part B, it reads that the following information relates to the dividend per share of Somolo Limited. You have seen the question? Yeah, so of Somolo Limited. So earning per share is for year 2016 was given as 6. Then dividend per share for the year 2015 was given as 2.4. Target payout ratio was 0.6. Then adjustment rate was 0.7. So using the Lindner model, predict the dividend per share for the year ended 31st December 2016. So to compute the dividend per share to be paid, when you are using the Lindner's model, we start with the current dividend per share. We multiply by adjustment rate. Then we also add in brackets the previous period dividends per share. Then multiplied by in brackets 1 minus the adjustment rate. So what you need to do first is to compute the current dividend per share because it has not been given. To get the current dividend per share, to compute what should be the current dividend per share, simply take the current earning per share. You simply get the current earning per share multiplied by the dividend payout ratio. Dividend payout ratio. So when you want to compute the current dividend per share, simply take the current earning per share multiplied by the dividend payout ratio. So current earning per share is the one for 2016, it was 6, multiplied by the dividend payout ratio. So target payout ratio is 60%. Payout ratio will be what? So the payout ratio will be 0.6. So multiplied by 0.6, that is the dividend payout ratio. So that we get the dividend per share, which will be, so we get a figure of 3.6. So now after that, we get the dividend per share to be paid. We now get the dividend per share to be paid. So current dividend per share is what we have just calculated. It is 3.6. Then the question had given you the adjustment rate. Are you able to see the adjustment rate? 0. What? 0.7. Then we add. So previous period dividend per share is the dividend for the year 2015. Are you able to see the dividend per share for the year 2015? It is 2.4. Then now multiply by 1 minus the adjustment rate. Adjustment rate is 0.7. So that should now give you what should be the dividend per share to be paid when we use the Lindner's model. When we apply now the Lindner's model of the dividend policy. So I've seen 3.24. So that now concludes our dividend policy. So I want us now to start on the management of the working capital, or simply working capital management. So let us now start the last item, which is meant to be management of the working capital. Niliwapea notes hizo, ndio? Management of the working capital. Online confirm whether you can see the notes for the management of the working capital. Management of the working capital. Online, you confirm whether you have some notes on the management of the working capital. Anyone else without the notes for the management of the working capital? So let us go through it. Let us check through that handout, the first part of it. We can check through the first part of it. So that first part of it, they were saying that that's now management of the working capital. So it refers to the management of the current assets and the current liabilities. It simply refers to the management of the current assets and the current liabilities. So it involves the administration and the policy guidelines of the current assets and the current liabilities. So current assets, working capital is simply the current assets minus the current liabilities. Working capital is simply the current assets minus the current liabilities. So you want to know how you can manage that item. So I've given you some importance of the working capital management. I've simply given you some importance of the working capital management. Like now, the first one, they are saying that it is important because working capital represents the largest proportion of the company's total investment. So working capital, actually, in any kind of the business, working capital is the largest proportion of the investment. That's the current assets and the current liability. The number two is that current assets are normally exposed to the risk of fraud, like cash. Cash is one of the current assets. So in any organization, that will be facing a challenge for that. Then number three is that working capital items are directly related to the sales volume. So when you want to increase the sales volume, you must also increase the working capital items. That's why it is also important. Then there is also the long-term condition normally set by the creditors represent that the company should maintain a given level of the working capital items. The current ratio 2:1 or acid test ratio is 1:1. Then number five, it is important to manage working capital items because management spends most of their time on the routine decision making, which is concerned with the current assets and the current liabilities. Those are now the reasons why it is important to manage the working capital. Then I've given you details concerning the working capital financing policies. The working capital financing policies. There are three of them. There are only three of them where they are saying that there are three types of the working capital financing policies. Number one is meant to be aggressive financing policy. Number two, conservative financing policy. Number three is meant to be moderate or matching financing policy. So if you check the first one, the one for the aggressive financing policy, they are saying that under this policy, all the working capital items will be financed using the short-term sources of finance. They will be financed using the short-term sources of finance. This is because short-term sources of finance are normally cheaper, and by the company using them, it will minimize the cost of doing what? Financing, but it will also increase its profitability. However, the company's liquidity position will decrease, and it will be because the company will be required to pay back the borrowed funds within a shorter period of time. Then they have talked about current assets of the company can be classified into two as follows. So permanent current assets. These are the assets which stay in the company for a period of more than how many accounting years? One. Then temporary or fluctuating assets, they are those current assets which fluctuates above the optimum level. The optimum level. That's now what we mean by aggressive financing policy. Number two should be conservative financing policy. So for the conservative financing policy, they say that under this policy, all the working capital items are financed using the long-term sources of finance, using the long-term sources of finance. Then they have continued to say this is because long-term sources of finance can be turned over several times before the maturity period of the loan repayment. Hence, a company using this financing policy will be liquid most of the time. However, profitability will do what? Will decrease since long-term sources of finance is normally expensive. Therefore, under this particular method, loan repayment is determined in advance. The last one is number 3, matching, not maturity. That should be matching or moderate. Make that change. We have already listed it up there. You can see up there number 3. It is moderate or matching financing policy. Moderate or matching financing policy. It is not maturity. So when you are now using that method under this financing policy, permanent working capital items are financed using what? Long-term sources of finance, while fluctuating or temporarily working capital is financed using what? The short-term sources of finance. So there is a question in your past paper in that part. There is a question in your past papers in relation to that. Let us go through that part and see what you are to explain on, what you are meant to explain on that item. So check May 2018, question 1, part A. So I want you to go to May 2018, question number 1, part A. May 2018, question 1, part A. So someone was requesting the notes to be shared. Have it been reposted? Those who are lacking the notes, have it been reshared back to the class group? Okay. So when you go through May 2018, there is a question number 1, part A. When you check through May 2018, there is a question number 1, part A. Question 1, part A, they were asking you to explain 3 working capital financing policies and their implication in an organization. 3 working capital financing policies. So those policies, number 1 is aggressive financing policy. Aggressive financing policy. So when we talk about aggressive financing policy, under this policy, working capital items, all the working capital items will be financed using what? The short-term sources of. So what are the implications? The implications are also explained there, where they are saying that this is because short-term sources of finance are normally what? Cheaper, and by the company using them, it will minimize what? The cost of financing, and also it will increase the profitability, but liquidity will do what? Will decrease. Those are now the implications you should be able to give them. Those are now the implications you should be able to give them. So you explain those 3 financing policies. So that is now what I wanted you to know in relation to that question. So you can read more and get to understand what is contained there. So there is another question now. We get a practical question. I want us now to get a practical question. This should be November November 2020. So it should be November 2019. Just go back by one sitting. November 2019, question number 2, part B. We now check November 2019, question number 2, part B. November 2019, question 2, part B. So that question 2, part B for November 2019, the question reads that Maua Horticultural Limited runs a flower export business. They run a flower export business. They run a flower export business. So the company has two sources of funds. The company has two sources of funds at different interest rates. At different interest rates. So the finance cost of the short-term fund is 20%, while the cost of the long-term funds is 25%. So these costs are expected to remain constant in the next 2 years. So the following are the projected monthly working capital requirements of the company for the year ending 31st December 2020. They have given you month from January to December. They have given you working capital requirements. So they have given you for all of them from January to December. Now required. Required Roman letter 1. Required Roman letter 1 is that the average monthly permanent. The average monthly permanent and the seasonal what? Working capital requirement for the company. Roman letter 2, total cost of the working capital finance. Total cost for the working capital finance for the company under aggressive financing policy, conservative financing policy, and also matching financing policy. Then finally, Roman letter 3, advise the company on the appropriate working capital financing policy to do what? To adopt. So let us start with the Roman letter 1, how to get the permanent and the seasonal. So if you want to get the permanent and the seasonal, you prepare a schedule on the working capital. You prepare a schedule for the working capital. We prepare a schedule. Just prepare a schedule of the working capital. So in that schedule, what you do, you will be having the column for the month. We shall have the column for the month. Also the column for the total working capital. Total working capital. Total working capital. Then we shall also be having the column for the permanent working capital. Also permanent. Total working capital. Total working capital. Then there is also permanent working capital. Also permanent capital. Then apart from the permanent working capital, there is also the seasonal working capital or fluctuating seasonal working capital. Seasonal working capital. Seasonal working capital. So there is the month, total working capital, permanent working capital, and also the seasonal working capital. So month, total working capital, permanent working capital, and also the seasonal working capital. So we start off with the month of January. We start off with the month of January. So how much are you given as the working capital required for the month of January? Yeah, so we have 35. So there are 3 zeros at the top. So we shall compute 3 zeros at the top, like that. So we have 3 zeros at the top. So permanent working capital, you check from January to December, which one is the lowest? The lowest among all the month would represent the permanent working capital. So check from January to December, which one is the lowest? The lowest is 35. So permanent working capital is the lowest among all the months. Permanent working capital is the lowest among all the months. So they have said it is 35. They have said it is 35. So to calculate the seasonal, subtract the permanent from the total. To get the seasonal, you subtract the permanent from the seasonal, which means it will be how much? So this one will be a 0, like that. It will be a 0. We go to the second month, which is February. So February, they gave you 35. They gave you 35. So permanent will never change, is the same, the lowest among all of them. So this is the 35. Then that means that one will be a 0. We go to the next month, which is March. So March, it is given as how much? 52,500. Permanent, we have said it is not changing. It's 35. So when you subtract 35 from 52,500, this is 17,500. You go to the next month, which is April. You go to the next month, which is meant to be April. So April, you are given which year? So April, we have 70. So permanent is not changing. It's 35. So when you minus 35 from 70, we are left with also 35. So you go to the month of May. Go to the month of May. So May, you are given how much? So permanent is which year? 35. So when you subtract that 5 from 105. Sorry? So I want you to proceed like that up to December. So you proceed in that order up to December. Then after that, you will get the total permanent and also the total seasonal first. So you continue in that order up to December. Then once you have finished that, get the total for the permanent and also the total for the seasonal and also the total for the seasonal. So I've seen seasonal 855, permanent 420. So we need to get the average because the question had asked you to calculate the average monthly, permanent, and seasonal. We now get the average permanent and seasonal. So we need to come up with monthly, permanent. So we start with average monthly permanent. We start by calculating the one for the average monthly permanent. So to get the average, to calculate the average monthly permanent, to get the average monthly, get the average monthly permanent working capital. You simply take that total, which is 420. 420 divided by 12 months. I know you still go back to 35. Remember 35? Yeah, so that's now average monthly permanent working capital. You simply take the total, divide by 12 months, because they say monthly. And remember, this one was for 12 months. Then also average seasonal working capital. So also average monthly seasonal working capital. You simply take what is there as 855. What is there as 8? It's 855. 8. So 855 also divided by 20. So that is now our Roman letter 1. That will be your Roman letter 1. Average monthly permanent and also average seasonal permanent. So average seasonal working capital. So that is now our Roman letter 1. So we go to Roman letter 2. We now go to the Roman letter 2. Roman letter 2, they would like you to get the total cost of the working capital finance for the company under aggressive financing policy, conservative financing policy, and matching financing policy. So that Roman letter 2, we start with aggressive financing policy. Let us start with aggressive financing policy. So Roman letter 2, we start with the aggressive financing policy. So under the aggressive, let us first comment that under the aggressive, we first comment that under this policy, comma, all the working capital items under this policy, comma, all the working capital items will be financed by the short-term sources of finance. All the working capital items will be financed using the short-term sources of finance. So let us see how to get that total cost. So to get the total cost on that policy, when you want to compute the total cost. So total cost will be equal to. So when you check through the question, the short-term sources of finance, they have what cost of capital? Yeah, so you will be getting 20% of that 420 plus 855, because all of them are financed using the short-term sources of finance. So the short-term cost of capital is 20%. So total cost, get 20% of 420 plus 855. Because all of them are financed using the short-term sources of finance. All of them are financed using the short-term sources of finance. So that is now under aggressive. Under aggressive. So you are getting which figure? Yeah, so let us now go to the second one, which is meant to be conservative financing policy. We go to the conservative financing policy. We now check the one for the conservative financing policy. So for the conservative, we comment that under this policy, all the working capital items, under this policy, all the working capital items will be financed. All the working capital items will be financed using the long-term sources of finance. All the working capital items will be financed using the long-term sources of finance. All the working capital items will be financed using the long-term sources of finance. So confirm in the question. Check in the question, what is the long-term cost of the long-term funds? Yeah, so we just repeat what we have done. Only change this one to 25%. Change this one to 25% and get that total cost. Because all of them are financed using the long-term sources of finance. So you simply get 25% of that total cost. You simply get 25% of that particular total cost. You simply get 25% of that particular total cost. So that is now the conservative financing policy. So finally, we go to the next one. The last one is matching or moderate financing policy. We now go to the matching or moderate financing policy. Matching or moderate financing policy. So we write something brief on that. We summarize that under this policy, permanent working capital, under this policy, permanent working capital will be financed. Permanent working capital will be financed using the long-term sources of finance. Will be financed using the long-term sources of finance. It will be financed using the long-term sources of finance. While the seasonal working capital will be financed using the short-term sources of finance. Will be financed using the short-term sources of finance. Will be financed using the short-term sources of finance. So let us now get that total cost. So total cost will now be equal to. So to get the total cost, we start with the long-term cost, whereby you get 25% of 420,000. And also short-term costs. The short-term costs. So for the short-term cost, it will be 20% of 8, 5, like that. Then add them together. That's now when you adopt matching or moderate financing policy. Permanent, use the long term. Seasonal, use the short term. Then add them together. Then you add them together. So that now will give you the total cost when you use the moderate or matching financing policy. When you use the moderate. So that is your Roman letter 2. That was now meant to be your Roman letter 2. So we go to the Roman letter 3. Advise the company on the appropriate working capital financing policy to adopt. So the policy you will adopt is where you incur low total cost. So which one has the lowest cost? Aggressive, matching, or conservative? Which one has the lowest? Aggressive. So we advise them that select the aggressive financing policy. Select the aggressive financing policy. Select the aggressive financing policy. Since it is where the investor will incur lower costs. Since it is where the investor will incur low costs. Since it is where the investor will incur the lowest costs. So that is now on that question. There is another question I will give you it as your assignment. This one will attempt it as your assignment. This one you will attempt it as your assignment. It is the same question, but you will try it at your own free time. So it is May 2012. May 2012. There is a question number 1, part B. May 2012. There is a question number 1, part B. Maybe you can just open, we go through it, but you do it as your assignment. When you check May 2012, question number 1, part B. When you check May 2012, question number 1, part B. So that question 1, part B reads that the projected monthly capital requirement of Jasimba Limited for the year ending 31st December 2012 is as follows. So they gave you the month from January to December. They have also given you amount of the working capital required. They have also given you the amount of the working capital required. Then expected cost of the short-term funds is what percent? 25%. While the long-term fund is what percent? 30%. They were saying you ignore the tax. So required Roman letter 1. Schedule showing amount for the permanent and seasonal. I've given you that schedule. You can see the schedule you have prepared. Yeah, that is what is required in the Roman letter 1. Roman letter 2. Average amount of the long-term and short-term finance that will be required. So long-term is the permanent working capital. You see that? Short-term will be the seasonal working capital. This is what I've done after getting the totals. You remember after getting the totals, we got the average for the permanent. We also got the average for the seasonal. That is your Roman letter 2. Then Roman letter 3, total cost of the working capital finance. If they adopt which policy? Aggressive. Roman letter 4, when they adopt conservative. Roman letter 5, when they adopt the matching policy. So you could also include their Roman letter 6, your advice, like the other question. You could also include there the Roman letter 6, where you advise as per the other question. So that one, you simply follow the other question. So we shall have no time to go through that, but it is same as what we have done. And it is actually straightforward. So I want us now to get another question. I want us now to go to another question. This one should be November 2020. We check the one for November 2020. we check November 2020, question number 2, part B. 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 Have you seen question 2, part B? The one for Nduru Suppliers Limited. So is reviewing its working capital commitment for enhanced efficiency. So the following information relating to the period ended 31st March 2020 is provided. So are you able to see the turnover? Turnover for the year they gave us how much? So turnover is the same as the sales revenue. Turnover will be the same as the sales revenue. Also cost as a percentage of the sales. Cost as a percentage of the sales. Direct materials is given. Direct labor is given. Variable overhead is given. Fixed overheads is given. Selling and distribution is also provided. They went ahead to say that additional information, not number 1, on average, account receivable takes 2.5 months before payment. Then raw materials are in the inventory for how many months? 3 months. Then work in progress represent 2 months worth of the half of the processed goods. Then also the finished goods represent 1 month production. Not number 2. Credit is taken as follows. Direct materials is 2 months. Direct labor is 1 week. Variable overhead is 1 month. Fixed overhead is also 1 month. But selling and distribution is a half hour, a month. Then not number 3, work in progress and the finished goods are valued at material, labor, and variable expenses cost. Then finally, number 4, labor force is paid for 50 working weeks in a year. So required, assess the working capital requirement for the company. Working capital requirement. So working capital is simply the current assets minus the current liabilities. Working capital will simply be the current assets minus the current liabilities. So working capital. Is simply the current assets, the current liabilities. Working capital is simply the current assets minus the current liabilities. So what we do some workings to get the current assets and also the current liabilities. So what we have been given is the turnover. We have already been given the turnover. So turnover, the question gave us which they were able to give 15 million. So we do some workings in relation to that. So our workings will be in relation to the total cost. Our working will be in relation to the total costs. So under the total costs, we start with direct materials. We start off with direct materials. So direct materials were given which percent? 30. So get 30% of 15 units. Get 30%. number, which is 15 million. So 30% of 15 million should give us which here? We get 4.5 million. We get 4.5 million. 4.5 million. So the next one should be the direct labor. The next one should be direct labor. So direct labor, they gave you what percent? So also get 25% of the 15 millions. Also get 25% of the 15 millions. 3.75. Then apart from the direct labor, the next one should be variable overheads. Variable overheads. Variable overheads. So for the variable overheads, it was what percent? It was 10% of 15 minutes. 1.5. The next one should be fixed overheads. Next one should be fixed overheads. So for the fixed overheads, it is what percent? So 15% of the 15. Sorry? 2.25 million. So the last one is meant to be selling and distribution. You also get the one for the selling and distribution. So selling and the distribution, it was which here? So we get 5% of the 15 million. So what I want you to do, when you go to the note number 3, you can see note 3. They have said that work in progress and the finished goods are valued at material, labor, and what? Variable expense. So because of that, I want you to add these 3 together. Because of that note. So add the first 3 together. Just get the total for the first 3. Because of that note number. Because of the note number 3. Yeah. Then let us now get the average current assets. Once we have finished that, we now get the average current assets. We now compute the average current assets. Let's now come up with the average current assets. The average current assets. Now calculate what should be the average. So average current assets, we know what are the current assets. The first one will be accounts receivable or debtors. The first one will be the debtors. The first one is the debtors or accounts receivable. So debtors or accounts receivable, we know it is the sales on credit. Or we know all that. So I want you to go to the bullet number 1. You can see bullet 1 on average. Accounts receivable will take how long? 2.5 months before payment. So it will be 2.5 divided by 12 months. In a year, we have 12 months. But now they have taken 2.5. So we assume all the sales were on credit. Debtors are credit sales. So multiplied by the credit sales, which is, we assume all the sales in this question were on. But if the question specify, you have portion. So our sales is the turnover. Our sales is the turnover. You see the figure for the turnover? They gave you how much? Yeah, so multiplied by 15. So debtors are our credit sales, but they take 2.5 months before they pay. Before they pay. So we stay with their money for 2.5 months before. So it becomes an asset. That is now for the debtors. Then the other item is the stock of the finished goods. So number 2 should be the stock of the finished goods. Stock of the finished goods. So stock for the finished goods. Stock for the finished goods. So when you go to the bullet number 4, you can see the bullet number 4 in the note number 1. Finished goods represent 1 month production. So for the finished goods, it will be 1 month divided by 12. But when you go to the note number 3, you see the note number 3. Work in progress under finished goods are valued at material labor, and that is the case. Some questions may not give you that sentence, but know that work in progress and also the finished goods are valued at material labor and variable overhead. So the figure I asked you to add, unakumbuka hiyo figure ndio wauliza mahali, you got how much? Sorry? 97. So that now gives you the stock. That now gives you the stock of the finished goods. That will now give you the stock of the finished goods. Give you the stock of the finished goods. Then we go to number 3. We go to number 3. Number 3 will be the stock of the raw materials. Number 3, which will be having it as the stock of the raw materials. So what you give in the stock is now what we shall have there. So you go to the note number 1, bullet number 2. You see note 1, bullet number 2. Raw materials are in the inventory for how many months? 3 months. Yeah, so the stock for the raw material, take 3 months divided by 12. Then we calculated raw material. What was the cost for the raw materials? You got which figure? The 30%. You got? So multiplied by 4.5 million. So that should now give you the stock of the raw materials. That is what will give you the stock of the raw materials. The next one should be the stock of the work in progress. We all know the work in progress, so we also have the stock of of the work in progress. So stock for the work in progress, you still check the note number 1, bullet number 3. Work in progress represents 2 months worthy of the half of the produced goods. So it will be 2 divided by 12, but multiplied by a half. You see that sentence? So work in progress represents 2 months worthy of a half of the processed goods. But we know in the note number 3, you see the note number 3, they say that work in progress and the finished goods are valued at what? Material, labor, and overheads, which means that it is a half of this figure. It is 9,750. Remember the figure I asked you to add. So we get a half of that. But now it is there for 2 months. It's there for 2 months. It's there. So if there was cash at bank or hand, cash balances. If there were cash balances, it would also have been included. But this question has no cash balance. So I want you to add those 4 items. They will give you the current assets. And those items together, they should be able to give you the current assets. So add them together to give you the current assets. Add them together to get the current assets. So after the current assets, we also compute the current liabilities. Let us also now calculate the current liabilities. Let us now also calculate the current liabilities. Now also compute average current liabilities. Now also compute average current liabilities. Also average current liabilities. So the first one is accounts payable or creditors. The first one will be accounts payable or creditors. The first one should be accounts payable or creditors. So for the accounts payable or the creditors, you got the note number 2. You see note 2. Credit is taken as follows. So suppliers of the raw material are our creditors. Suppliers of the raw materials are our creditors. So they take how many months? Yeah, so it's there in the note number 2, bullet number 1. Direct material is 2 months. So take 2 over 12 multiplied by the cost of the raw materials. So remember the cost of the raw material was how much? 4.5. Yeah, so multiplied by the 4.5 millions. Multiplied by the 4.5. Multiplied by the 4.5 millions. The number 2 will be accrued wages. The one for the labor that has not been paid, which will be referring to it as accrued wages. We have the accrued wages. So direct labor, they gave you how many weeks in the note number 2? So when you check note number 4, there are how many weeks in a year? Yeah, so you will take 1 week, divide by 50. We calculated the figure for the labor cost. How much we get up there as the figure for the labor cost? Sorry? 3 So that now should give you wages, which is the same as the direct labor, accrued labor that has not been paid. That has not been paid. That has not been paid. The next one, number 3, will be accrued variable overheads. Variable overheads. For the accrued variable overheads took how many months in the note number 2? So it is 1/12. How much was the value for the variable overheads in our workings? 1.5 million. So get that here. Then the next one should be accrued fixed overheads. The next one should be accrued fixed overheads. So for the accrued fixed overheads, it is also 1 month, but we divide by 12. So how much should be there for the fixed overheads? Then apart from the accrued, there is also accrued saving and distribution. Accrued saving. So accrued selling and the distribution, a half a month. The same as 0.5 divided by 12. Half a month will be the same as 0.5 divided by 12. How much was the value for the fixed selling, for the selling and distribution? So you will add them together. That is now your current liabilities. You add them together, and that is now our current liabilities. You add them together so that you get the current liabilities. So now get the working capital. So get now the working capital. So working capital is simply current assets minus current liabilities. So take what you have calculated as the current assets minus what you have as the current liabilities. Umepata ngapi? Kila mtu anapenda should not be bothering about your name. And they will mark according to what you have written. Someone online amenipea 47,062.50. So what were the current assets? Current asset is 5875. So confirm, then current liabilities, it is which figure? 1168,750. So that difference is what is giving us 4,707,000. Number 6. Yeah, 4,706,250. Yeah, so that is now what we have as the working capital. So there is another similar question I want us to check. May 2014. Question number 5, part B. Go to May 2014. Question number 5, part B. May 2014. Question number 5, part B. So check May 2014. Question number 5, part B. May 2014. Question number 5, part B. So when it comes to May 2014, question number 5, part B. So that question reads that the board of directors of Randa Millers Limited have requested you to prepare a statement showing the working capital requirement for the level of activity of how many units? 40,000 units of the output for the year. The cost structure for the company's product for the above mentioned activity level is given below. For the above mentioned activity level is given below. So they gave you raw materials, direct labor, variable overheads, total profit, and the selling price. So additional information, not number 1. Past experience indicates that raw materials are held in stock on average for how many months? 2 months. Work in progress, 100% complete in regard to material, 50% for labor and overheads will be a half a month production. Not number 3. Finished goods are in the stock on average for how long? 1 month. Then credit allowed to the supplier is 1 month. Then credit allowed to the debtors is 2 months. Then minimum cash balance. This one has given the cash balance of 2,000. Is expected to be maintained. So required. Prepare a statement of the working capital requirement. So we start by doing some workings. We start by coming up with some workings. So this time around, they did not give you the sales in value. They gave you the units and also the selling price. So we start with the turnover or the sales. We do some workings. The first working, we get the sales or turnover. We simply calculate the sales, revenue, or the turnover. So sales revenue, activity level, they gave us how many units? 40 multiplied by, are you able to see the selling price per unit? It's given us how much? So multiplied by 500. It's giving us 20 minutes. The next item should now be the total cost. The next item should now be, so under the total cost, we start off with the raw materials. Start off with the raw materials. So for the raw materials, you still take the 40,000 units. 40,000 units. What is the material cost per unit? Multiplied by. So that should give us which value? Now put that 8 million. The next item there should be direct labor. The next item should be direct labor. So for the direct labor, it is also 40,000. But this one we multiply by what? By 9. And I put that one to not 2 million. Then the last one is the variable overheads, also with the overheads. The last one is also 40,000 multiplied by what? So you will add these 3 items together. Add those 3 items together. That's right. So total is coming to which there? You are getting 16 million. So after that, now we do some workings. We start with the average current assets. Now start with the average current assets. Now start off with the average current assets. We start with the average start off with the average current assets. So average current assets, we say the first one is which item? The first one is the debtors. The first one should be the debtors or accounts receivable. So debtors are normally on credit sales. The first item there is the debtor. So debtors are normally on the credit sales. So when you go to the question and you check the note number 5, sorry, you see the note 5. Credit allowed to the debtors is how many months? Yeah, so note number 5, they gave you credit allowed to the debtors. So it is 2 over 12. You get 2 over 12 multiplied by what was there as the sales. So sales we got how much? So it was 20 millions. Right. So that is now what should give you the debtors. So some questions may tell you that 1 quarter was on cash. That means 3 quarters was on credit. Here we only use the credit sales. Debtors are sales on credit. So if you get a question that has said that maybe 1 quarter is on cash basis, get 3 quarters of that figure to be on credit so that you use it. Don't use the total sales if they say some are on cash. So debtors are only credit sales. So that's now the first one. The second one will be the stock of the finished goods. The second one should be the stock of the finished goods. The stock of the finished goods. The next one should be the stock for the finished goods. So stock for the finished goods. Are you able to see the note number 3? Finished goods are in the stock on average for how many months? So it will be 1 over 12. I ask you to add. So finished goods are always valued at material, labor, and overheads, even if the question does not explain that. You remember in the other question they explained. So what total are you getting? The figure I asked you to add. 16. So multiplied by 16 million. Remember, it is only material, labor, and variable overheads only. Then number 3 should be the stock of the raw materials. The next one should be the stock of the raw materials. The next one should be stock of the raw materials. So to get the stock of the raw materials, You go to the note number 1. You go to the note number 1. Note 1, past experience indicates that raw materials are held in stock on an average of how long? So get 2 divided by 12. So what figure are we getting for the raw materials? We calculated. So multiplied by 8 millions like that. That should be able to give you the stock for the raw materials. Be able to give you the stock for the raw materials. The stock for the raw materials. Apart from the stock of the raw materials, we go to number 4. 4 should be the stock of the work in progress. Number 4 should be the stock of the work in progress. So work in progress, I want you to check in the note number 2. Note 2, they say that work in progress 100% complete in regard to material, 60% for labor and overheads. So that will force us to separate them because of their degree of completion. The other question, there was no that kind of information, but for this one, we know work in progress is valued at material, labor, and variable overhead, isn't it? But they are not all at the same level of completion. So because of that, we separate them. We start with the one for the materials first. We start with the one for the materials first. So for the materials, if you check over that note number 2, work in progress is 100% complete in regards to material work. But when they cross the practice, it will be a half of a month production, isn't it? A half a month, we say it's the same as 0.5 divided by 12. A half a month is the same as 0.5 divided by 12. Then multiplied by what was the cost for the raw materials? It was 8, but it is 100% complete. It is 100 over 100 like that. So that now you get the value for it. It was 100% complete, but it is just a half a month. 100% is the same as 1. That one is having no problem. It is just you take 0.5 multiplied by the 8 million. Because it is 100% complete. Because it is 100% complete. So 100 over 100, it is just 1. That one is clear for that. Then the next item should now be labor. The next item should be labor. Labor, it is also 0.5. Also divided by 12. Multiplied by labor, it was how much? So it is 2 million, but this one is what percent complete? So it is 50 over 100. Get the value. Get the value. The next one should be the overheads. So for the overheads, you also take 0.5. Also divide by 12. Then multiply by overheads was which figure? Look calculated was 6 million. So you also take the 6 million, which it is also 50% complete. Material and labor and overhead were 50%. So also multiply 50 over 100. The reason why I've separated is because of material. Material is 100%. Lakini this is given 50% complete. We apportioned them. But the other question, there was no that kind of completion. All of them were together. But now, this one, I've separated them because material is 100% complete. Labor is 50%, overhead is also 50%. But this part is not affected. That part is not affected. If there was no this item, we could have taken only one of these, but multiplied by 16. Yeah. But now that their degree of completion is different, work for each separately. Then, when you will add them together, that is what we give you the stock for the work in progress. That is what we give you the stock for the work in progress. So we separate them in that manner. Then, this question also had number 5. The cash balance. Number 5, the cash balance. So cash balance was given. The cash balance was given to you. Now I'm happy in the note number 6. Yeah, so I'm going to include you as part of the current assets. Then now get their total. Get their total now to give you the current assets. Get their totals now to give you the current assets. So add them together to give you the total current assets. So adding them together to get the total current assets. So how much is there as the current assets? Those who are online, what are you getting as the total current assets? Anybody who have calculated? Anyone who has gotten the totals? $6,750,000. So online, someone has given me $6,750,000.
Yes.
When you round off.
Yeah.
Yeah, so we can just use 6,750,000. Let us use 6,750,000. So that is now what we can get from there. Then let us now also calculate the current liabilities. We should also come up with the average current liabilities. We should also come up with the average current liabilities. Average current liabilities. Let us also compute the average current liabilities. We should now also compute the average current liabilities. Also their average current liabilities. So let us get the average current liabilities. This question it had only one, the creditors or accounts receivable. It is only one, the creditors or the accounts receivable. It is only one, which is the creditors or simply the accounts receivable. Yeah, the creditors will be the accounts. So when you check through the note number 4, credit allowed to the suppliers, they gave you how long?
1 month.
So it will be 1 month over 12. 1/12. So are suppliers of the raw materials. How much did we get as the figure for the raw materials? Sorry?
80.
So multiply by 8 million. So our creditors are the suppliers of the raw materials. So they want to take 1 month. You have to take 1 month in the note number 4. Credit allowed to the supplier is 1 month. So it is only one. There is no other current liability that was given in the question. So once you have calculated that, now get the working capital. Working capital is simply the current assets minus the current liabilities. So now get your working capital, which is simply the current assets, we minus the current liabilities, which is simply the current assets minus the current liabilities. So what are you getting at that level? You're getting 6 million. It is 6,080,333. Yeah, so we can have it now at that portion. So the next item I want us now to go to will now be, we want now to go to each separately. So I want us now to go to the cash management. Yeah, to one of the current assets. So you want to go to each specific. So that one I want you to check in your notes. In your notes, go to page 4. Go to page 4. In your notes on page 4. There is somewhere they have indicated cash management. You can see big the cash management. I want us now to go to each current asset. What we have done is the combined. So now we go to each current asset. So the first one, in your book, you can write there as the cash management. So let us now go to the cash management. Let us go to the cash management. We now go to your notes. On page 4, there is an item there known as the cash management. So when it comes to the cash management, they are saying that there are normally 2 models of the cash management. There are normally 2 models of the cash management. You can see there is Baumol cash management model, Miller and Oro's cash management model. So we shall start with the BOM model. When it comes to the BOM model, they have said that the model was developed out of what? Economic order quantity model. EOQ is economic order quantity model. We shall be discussing that. Then they have given the formula, but I will be giving you a better one, which you will write in your book. So while the formal model of the cash management is expressed as follows, I will be explaining those terms. So what I want you to check first is the assumptions of the formal model. You can see the assumptions for the formal model. The company cash expenditure is known in advance and it is what? Constant. The number two, the rate at which cash will lose value is constant per period. The next one is that there are investment opportunities in which short-term cash can be invested into, and it is possible to convert this investment into what? Liquid cash within a short period of time. Number four, there is no buffer stock or cash allowed to be kept by the company. Then number five, there may be other normal cost of holding cash, which may increase the average amount held. So I will be using the questions. So let us now get some questions on that BOMOL. So in your notes, put there number one as the BOMOL cash management model. So we can have the BOMOL cash management model. BOMOL cash management model. So I will be going direct to a question. So the question I want us to deal with is November 2011, question number 4, part B. November 2011, question number 4, part B. November 2011, question number 4, part B. I want us to check November 2011, question number 4, part B. November 2011, question number 4, part B. November 2011, question number 4, part B. So are you able to see question number 4, part B? Barren Limited. Have we seen that question? So projects that cash outlay of how much? 45 million shillings will occur uniformly throughout the year. The company plans to meet its cash requirement by selling marketable securities from its portfolio. So the expected return from the company's marketable security is what percent? 8% per annum. The cost per transaction of converting the security into cash is how much? 30 shillings. So required Roman letter 1, the optimal cash balance. Roman letter 2, average cash balance. Roman letter 3, number of transfers between cash and the marketable security. So we start off with optimal cash balance. So optimal cash balance in the notes, the handout, is what they are referring up there as C. So I'll give you the formula, then I explain the content of that formula. I will give you the formula, and I explain the content of the formula. So C is the optimal cash balance. It is supposed to be equal to, so C be given by 2FT, then divide by K. I want to explain what they stand for. So to calculate the optimal cash balance is the same as C. It will be equal to 2FT divided by K. 2FT divided by K. Where in the handout, K is interest rate on what? On the marketable security. K is the interest rate on the marketable security. Then C is what they are referring to as the optimum or optimal cash balance. Optimum or the optimal cash balance. F is the fixed transaction cost. F is the fixed transaction cost of selling the marketable securities per transaction. The fixed transaction cost of selling the securities per transaction. Then T is the total amount of cash required for the entire period. The total amount of cash required for the entire period. So that particular T is the total amount of cash required for the entire period. So let us now answer the Roman letter 1. So we can get now our Roman letter 1. So F has been given on F. The fixed transaction cost per transaction. Tumepewa 30 shillings. Ona your 30 shillings. 30 is our F. G is the total amount of cash required. It is 45 millions. Are you able to see the 45 millions? So multiplied by 45 millions. K is the interest rate. What are we given there as the interest rate? 8%. So 8% is the same as 0.08. Then you get that. So F is the transaction cost per transaction, which has been given as 30 shillings. Then the cash outlay for the entire year is 45 million. That is our K is the interest rate, which is 8%, 0.08. So what should we come up with as the optimal cash balance? Nona 183,712. So 183,712. So that should be our Roman letter 1. How to get the optimal cash balance. So we go to the Roman letter 2. Roman letter 2, they want to get the average cash balance. Average cash balance. The average cash balance. So when you are calculating the average cash balance, average cash balance, average cash balance is supposed to be given by annual demand. Annual demand divided by number of days in a year. Number of days in a year. So annual demand is your T, the cash required in a year. Then when the question has not given you the number of days in a year, we assume there are 365 days. But if they give you, you use the one that has been given. So this question will not give you. So our assumption will be 365 days. So to get that figure, simply get 45 millions divided by 365. When they specify the number of days, use the ones that are given. But if they have not specified, we assume there are 365 days. That's now how to get the average cash balance. How to get the average cash balance. So we go to the Roman letter 3. Number of transfers or orders. Number of the transfers or orders. Number of transfers or orders. So it is simply T divided by C. It is simply T divided by C. So we know T is how much? 45 million. C, you got 183. 7. So you round them off upwards, and order should be rounded off upwards. The list is less than 45. So that you take into account the customers. So number of the orders or transfer, round them off upwards. Even if it is 0.2 or 0.1. So that you cater for all the customers in your business. How many orders are we going to have? 245 orders. For the orders, never round them off downwards because you are supplying your customers. If you round them off downwards, one of your customer will miss, and you know the consequences of losing one customer. So you rather round off upwards, buy more, the balance will go to the next sales. But if you round off downwards, you are minimizing your stock and it will affect your customers because finally you will sell. You will rather say apply more. So sometimes they normally ask you the frequency of making orders. Let us have their Roman letter 4 as frequency of making orders. The frequency of orders. So how long does it take to make an order? So frequency of making orders. So if the question asks you the frequency of making orders, you simply say that 245 orders. 245 orders or transfers are for 365 days. One order will take how many days? Just in case the question asks you the frequency of order. We simply say that 245 orders is for 365 days. How about one order? How about one order? About one order. One order will take how many days? Sorry? Days you don't round them off. The days you don't round them off. Order is the one you round it off. Because the days it can be seconds, minutes, and hours, isn't it? I have seen 1.48. Yeah, at least you use the seconds, minutes, or hours. So it is 1 hour and 1.48, isn't it? So you can round it off to 1.49. You can round it off to 1.49 days. Yeah. So they normally also ask you to get the total cost. You can also have Roman letter 5 as the total cost of maintaining the cash balances. Let us also have the total cost of maintaining the cash balances. The total cost of maintaining the cash balances. Total cost of maintaining the cash balances. So to get the total cost, we start with the holding cost. We start off the holding cost. So holding cost will be a half CK. So to get the total cost, holding cost, among the total cost, the first one with the holding cost will be a half CK. We have all these details. C, we know we got 100 and what? 183, 712. So K is the interest rate, which is what percent? 8. So 8% is the same as 0.08. That should give you the holding cost. That should be able to give you the holding cost. Then also ordering costs. Also ordering costs. Ordering cost is given by T divided by C. F. All those details we have. So ordering cost is T over C F. It is simply the number of orders multiplied by the ordering cost per order. So T was 41 millions. 5. So C, we know it is which figure? 183.7. What was our F? Our F was 30. So those two figures, they are the same. We know economic order quantity. At economic order quantity, ordering cost and holding cost will be the same. So those two figures are meant to be the same. Then you add them together. The two figures are meant to be the same. Then add them together. Then they should be the same. Maybe small rounding off. Just a small rounding off, but the two figures should be the same. Are you getting the same? Then when you add, what should we come up with? Sorry? So there is another question also still in your past papers. December 2021 exam. December 2021, question number 5, part B. So let us check December 2021, question number 5, part B. The one for the real exam, not the pilot paper. Una December mara mbili 2021, the pilot paper and the one for the exam. So not the pilot paper, but I want you to check the one for the real exam. Question 5, part B. Question number 5, part B. Are we able to see question 5, part B for December 2021? So first part B, they say that you analyze 3 motives of holding what? Cash. Maona your part B. Analyze 3 motives of holding cash. I'm referring now to your notes. You go back to your notes. You can see the end of page 4. When you check in your handout, end of note, page 4. Are you able to see the reasons why individuals and firms hold cash? Are you able to see those reasons? Then when you proceed, number 1 is for what purpose? Yeah, the first motive of holding cash is for the transaction purpose. Is for the transaction purpose. Motive number one of holding cash is transaction purpose. So cash balances are necessary in the business operation because you to make payment. Number two is for what? For precautionary measures. For precautionary measures. Remember, it is unpredictable outside there. When it rains, the fare normally goes up, isn't it? So you must have emergency cash for precautionary measures. That's what we mean by for precautionary measures. Then number three is for speculative purpose. For the speculative purpose. Ukiwa na offer, you can go and transact, isn't it? So those are the three main objectives of holding cash. Then apart from those ones, now you can include number four, financing the borrowed amount and also to enable the company to pay its bills on time when they fall due. But the key three ones are transaction, precautionary, and speculative. That is what was required now in that question. Then we go to part C. We now go to part C of the same question. We go to part C of the same question. So part C, they have said that Jasmine Limited generates how much? 100,000 per month. Excess cash, which intend to invest in the short-term securities. The interest rate it can expect to earn on this investment is what percent? 10% per annum. The transaction cost associated with each separate investment of the funds is constant at how much? At 500. So required, Roman letter 1. Optimal amount of cash to be invested in each transaction. So we start, that is the same as C. So we start by calculating C. Start off by calculating C. Start off by calculating C. So we have said that C is equal to what? 2FT divided by K. Then you have it like that. So T was given per month, but interest rate was given per annum. So you convert them into per annum, isn't it? So T per month, they gave us how much? Yeah. So you take 100,000 multiplied by 12 months. Itatupea 100 and 120. 1.2. We get 1.2 million. So now you come back and calculate our C. So 2, F is given as how much? The transaction cost. That's the 500. And multiplied by 1.2. Then also K is what percent? 10%. And that is the same. So we go to Roman letter 2. Number of transactions per annum. That's the same as the number of transfers or orders. Umepata 100 and what? Sorry? 109. Like that. Online, is that the figure that all of you are getting? Online, is that the figure? Yeah, so now from there, we go to Roman letter 2, number of the transactions per annum. Number of transactions are the same as the number of transfers or orders. Number of the transfers or orders. Number of transfers or orders. Remember, it was T divided by what? T. So T is 1.2 millions. C is 109,545. You get 11 orders. So I'm told it is 11 orders or transactions. We go to Roman letter 3. Roman letter 3, total cost of making the transactions. So they want you to get the total cost. So total costs, we start with holding costs. Remember the holding cost? It is a half. Was it CK? It was a half CK. So it will be a half. C, we know it is 109,545. K, it is 0.1, that's 10%. So then there is also ordering cost. Also details ordering cost. Ordering cost, it is T divided by C, F. F was how much? 500. So the two figures should be the same. The two figures should be the same. Then you add them together. Then now we go to the Roman letter 4. Opportunity cost is the same as the total interest. Opportunity cost will be the same as the total interest. Opportunity cost is the same as the total interest. Is the same as the total interest. So that total interest, you simply get 10% of the 1.2 millions. So opportunity cost is simply the total, which will be 10% of the 1.2 millions. The 10% of the 1.2 millions. So here is your formal cash management. Kuna hiyo ya bila and oral. Sasa hiyo hatuwezi tukadiscuss sasa hivi. Tutaanza kuchukia FM. Sema ni rahisi, lakini saizi nikienda kwa hiyo model niwapee formula ingine utaanza kuichukia, si ndio? So for the evening I will meet you on Tuesday, the normal class. Tunakuanga nayo on Tuesday. Early morning tutapatana na nyinyi pia on Tuesday. Evening tunakuanga na wao on Tuesday evening, si ndio? So that one we shall have our normal class. Then early morning tutapatana na nyinyi pia on Tuesday. Ndio tuone kama tutamalizia. Tusipomalizia nitawaita tena. Hii sio ngumu, it is structured. The remaining part is structured. You see what you are doing at the moment? It is the formula and you do something. So the remaining part is more of structured. It is not an application. Then it's your room. You only need some like 1 or 2 hours. You will understand what we have done. When you get 2 or 3 hours, just to go through what I've done. You see what we have done today? Aggressive, it is not complicated. It's just a format. Current assets, current liabilities, just a format. Even what we are doing now is just what? A format. So early morning, remember we meet on Tuesday, the normal early morning class. For the evening class, we shall also meet on Tuesday in the evening during the normal class. I check whether we shall finish. If we don't finish, I will request you another day. We finish it off from there. So we can stop there for now. We can now stop there for now. Yeah. Sasa mwingine ananiuliza early morning on when? Sasa huyu mtu alikuwa I have explained like 3 times. I have said all of you are meeting you on Tuesday, isn't it? Early morning, Tuesday, the normal time. Then evening on Tuesday, also in the normal time. So I hope now I'm clear to everyone. Najua watu wanakula lunch saizi. I know some of you are taking lunch. Just let us use the days I've specified. If there will be anything remaining is when I will check on that. So let us stop there for now. And make sure you attend. Some of those things are what you'll be meeting in class. It's very easy. Once you can even just write a formula, you'll get some marks on it. But if you don't have the formula, you'll not be able to write.